Hi everyone, good morning. So today we are going to start with leverage buyout advanced question and answers. This is episode 32. My name is Deepak Bisht. So without wasting any time further, let's get started. So question number, okay, so leverage buyout, this series actually has 12 questions and all of these questions are actually uh, complex in nature and not well-known questions. So this section is most applicable to you if you are interviewing for a private equity job or if you have a lot of LBO experience, leverage buyout experience on your resume, and you really need to know the in and outs of an LBO model. And also note that there is going to be a overlap between merger models and a LBO model question and answers because many of the elements in a merger model were okay, many of the elements from merger questions, merger series, merger and acquisition series, like purchase price allocation, deferred tax assets and liabilities, and creation of goodwill, works the same way in both models. So, if you are new to the channel, I would suggest you to go to the merger and acquisition series, advanced and basics, for a better understanding. So, let's get started. So question number one is about the different type of debts that are used in an LBO. So different kind of debt you can use in an LBO and the difference between everything. So before we start with the debt concept, let's understand the key concepts which are related to debts. So the first concept here is the tenor. So tenor is just a fancy word for how long the loan lasts. For example, 5 years, 3 years, or whatsoever is the time period the loan is going to last for. And after that, it's seniority. So seniority is the order in which the lenders get paid if the company goes bankrupt. So seniority, uh, the loan which is senior secured, it means that it's first in line and it's protected by a collateral. And afterwards, there is junior or unsubordinated loans. So junior unsubordinated or senior unsecured, these are later in line. And after that, at the last, the equity, the owner gets I mean, the equity owners get paid after everyone else is paid. So debt holders are paid first. Debt and preference shareholders are paid first, and the equity shareholders are paid last at the last. So that's defined the seniority. Floating versus fixed rate. So a floating rate means the floating rate changes with the market, like an adjustable rate mortgage. Uh, and the fixed rate, actually stays consistent and constant. So LIBOR is London Interbank borrowing rate. So London Interbank offered rate. So at this rate, this is the benchmark rate, and there they will decide a spread. So let's assume that the spread is 1%. This means if today's LIBOR is 10%, so 10 plus 1 will be 11%. So that's going to be the interest rate. And if the LIBOR decreases, so our interest rate also decreases. So the floating and the fixed rate, that's the difference. And after that, amortization. So amortization is how can you pay back the principal. So basically, amortization represents that. Um, so it could be a straight line, or mean it straight line means that there would be equal principal payments each year. It could be bullet. So all principal is paid at the end. So it's common for bonds, bullet payment. Uh, then there is minimal, which means a small percentage per year, and there could be no payment also. So you pay only interest, and you pay the whole debt at the end, which also represents the bullet structure of the amortization of a bond. So basically, you will understand all these amortization structures when you will read the fixed income. And if you have interest in fixed income securities, there you will understand all these concepts thoroughly. Okay, so after that, the next point is call protection. So call protection is the rules that prevent the company from paying off a loan early. So this protects the investor who want to keep earning interest rate. If you have ever had a personal loan or any kind of loan, if you ask the bank for a prepayment, so they will. So there are clauses in the contract, in the amortization schedule, which is actually shared by the bank. So it actually has a clause. So bank, uh, there are certain rules or certain penalty for prepaying the loan, and okay, and interest rates. So interest rate is actually the cost of borrowing, and so interest rate is actually the cost of borrowing, and higher the risk, higher will be the interest rate. So as you move down the capital structure, reflecting higher risk and low seniority, that's interest rates. Interest rate actually rises with the risk. Okay, so I hope this portion is clear because these are the elements which are going to. So for every security, every kind of debt, these are the plugins which are different. So if the tenure is high or long, seniority is high, low, floating or fixed interest rate, amortization, call protection, interest rate. So all these concepts, all these pointers mix up, and they actually make different kind of debts. So let's talk about the different kind of debts. So let's understand the revolver. So revolver is actually a revolving credit facility. So think of it like a company's credit card. So here the interest rates are the lowest, and the rate is floating rate, and the term or the tenor of the bond is of the revolver is somewhat around 3 to 5 years. Amortization is none and primarily used for working capital or liquidity. So a revolver is used for uh, working capital or liquidity primarily, and you borrow and you repay as needed. Seniority and security. This is senior secured, which means if a company goes bankrupt, this will be paid first because it actually it's based on collateral, so that's why it's secured. This means secured means it actually has it's given on the basis of a collateral. Covenant means covenants are the maintenance covenants. It comes with maintenance covenants and monitored regularly. So maintenance covenants are strict rules, and investors are conservative banks, and call protection is none. So we have not discussed about call protection. We will discuss it about in a while. So so the purpose here for a revolver is it's used for short-term needs like covering temporary cash shortfalls. So that's a revolver. If we talk about term loan A or term loan B, so the difference here is that the interest rates are low for a term loan A, but interest rates are high for a term loan B because if you are already having a loan and an additional loan, the interest this means that the company is not able to generate enough cash to pay off its loan, so they want a loan to support their own operations. So that's why your interest rate on a term loan B is actually higher than a term loan A. And amortization is a straight line over 4 to 6 years. Uh, but because of the circumstances, amortization for a term loan B are actually minimal and typically 1 to 5% per year. If you talk about seniority and security, so this was senior secured and this is also senior secured. So term loan A and term loan B both are senior secured. And covenants, one has maintenance covenant and another has in incurrence covenants. So incurrence covenant and maintenance covenants. We have discussed about maintenance covenants and incurrence covenants previously. Investors here in a term loan A are actually banks and some institutional lenders. And here, because of its risky nature, term loan B actually has investors like hedge funds and institutional investors. And the purpose here for a term loan A, it's popular in private equity because repayments are small and keeping it actually keeps the company cash free. So it's sorry, it's the term loan B. The term loan B is actually popular in private equity because repayments are actually smaller and because of minimal amortization, and it actually keeps the company cash free. But the purpose of a term loan is actually it's a stable, low risk loan, and it's paid off gradually. So that's the difference between term loan A and a term loan B. And if we talk about senior notes, so senior notes are I mean, the purpose of senior notes is that it's flexible. It's just like bonds. So senior notes are the interest rate for a senior note is actually higher than a term loan B, and the fix also it's a fixed rate in fixed interest rate, not floating. And amortization is actually bullet. This means the principal will be due at maturity, and that's why it's riskier, more riskier, and that's why the interest rate is also higher because of the amortization schedule. Seniority, seniority and security perspective for a senior note is that it's unsecured. So that's the difference between a loan and a note. Understand this thing. So loans are major. If it's a loan, then it's actually secured, any kind of loan. But any kind of note, debenture, at times they are unsecured. If it's unsecured, then there is no underlying collateral supporting the loan. And the covenants are incurrence covenants. So incurrence covenants are actually more stricter than okay, though the incurrence covenants are actually more flexible as compared to a maintenance covenant. And investors are institutional investors, and there is a call protection also. The call protection is yes, there is a call protection, and the purpose is that it's flexible, long-term debt that does not require annual payments. So that's the purpose of a senior note. Okay, I hope these four kind of loans are clear. So let's move to next kind of loan, subordinate notes or junior debt. So, so these are actually riskier bonds. The subordinate notes or junior debt are riskier bonds that get paid back after the senior notes. And when we discuss about the seniority, so senior notes, unsecured, and then subordinates, these come later in the hierarchy and are paid later on. So the interest rate are higher because of the risk with these kind of loans. Uh, and the interest rate is majorly fixed. The amortization is bullet also. So this is actually one more additional point which increases the risk along it being uh, unsecured. So and seniority is after it's a senior subordinate. So it is paid after seniors. It's paid after senior secured loans, and covenants are typically incurrence. So typically incurrence covenants are embedded in this kind of debt or no, subordinate notes. And investors are actually specialized fund only. So this is tricky. And mezzanine debt is also, I mean, mezzanine debt, the last kind of debt, here the interest rates are highest, and offer includes a PIK, which is payment in kind option. And the amortization structure is bullet, and the seniority and security is that it's unsecured or equity like. So it would be treated like a equity only. And that's why it has the highest interest rate. So if we discuss, if you look at, if we look back and see the interest rates for other type of debt securities, so they are higher, higher, low, low, but it is the highest. So mezzanine debt is actually the highest, and it's actually treated like an equity. And covenants are incurrence covenants. So investors here are specialized even investors like mezzanine funds or specialized investors only. Mezzanine debt is very complex, and like I said, if you are into fixed income market, so read a little about those securities. then you will get a better understanding. And leverage buyout is majorly about debt. So let's move to next point. I hope. Okay, and these questions are difficult. I understand that, and these are supposed to be difficult because these are not for entry level, and these are not for entry level jobs. These are for higher level jobs. So let's move to next question. And okay, so let's understand this thing one more time. That uh, why does any of this matter in an LBO? So private equity buyers mix these kind of debts to keep interest costs manageable and avoid any large repayment. And also this gives themselves a flexible cash flow and which actually further on increases the results by using more leverage. So the debt risk is matched to the investor's appetite. I hope this made some sense. So let's move to question number two now. So question number two is how would an asset write-up or asset write-down affect an LBO model? And walk me through how you adjust the balance sheet in an LBO. So in an LBO, adjusting the balance sheet is conceptually similar to the merger model, but with a few key differences. And the purpose of the adjustments is to reflect the purchase price allocation, incorporate the new capital structure, and ensure the balance sheet balances after the transaction. So let me just okay. So just give me a moment. Okay, so first, what is actually an LBO model? So, when a private equity firm buys a company mostly using borrowed money with part cash, so that's an LBO. And think of it like buying a rental property using 20% of your own money and 80% of debt. So, when a company is bought, its balance sheet must be reset to reflect the new ownership and the financing structure. And what is a asset up write up and an asset write down? So, when a buyer actually purchases a company, the purchase price rarely equals the book value of the company's assets. So accountants actually adjust assets to match purchase price. So write up means increase assets value and write down means decrease assets value. So these adjustments also create goodwill or intangible assets and accounting items that represent the premium. The goodwill and intangibles are created because it represents the premium the buyer actually paid above the market price. And how the write-ups and write-downs affect the LBO model? So what they do is actually they basically change the company's asset value. So if assets increase, so it's basically a write-up. So the balance sheet shows higher asset value. If the asset decreases, it's a write-down, and the balance sheet shows lower values. This affects the depreciation and amortization because of the write up and write down. So increasing the asset means that there is going to be higher depreciation and amortization and lower accounting profits, and decreasing the assets means lower depreciation and amortization. And this matters because the cash flow changes, which affects how quickly the private equity firm can pay off the debt. And later on, they create deferred tax assets and liabilities because of the asset write up and write down. So when asset value changes from accounting for accounting purposes, taxes often do not change immediately. This create deferred tax liabilities or deferred tax assets. And in simple analogy, in simple words, if you owe tax later, that's a liability. If you have prepaid tax, it's a deferred tax asset. And they show up in the sources and uses of funds. So write-ups do not cost cash, but the new financing fee and changes in working capital appear on the LBO's cash sources and uses schedule. And so, how do we adjust the balance sheet in an LBO? Uh, okay, so when you buy a company in an LBO, the balance sheet is rebuilt to show the new debt used by the company, new equity from the private equity firm, and the adjusted value of the company's assets, and also the old shareholders' ownership is erased. So let's understand this step by step. So first of all, what do we do? First of all, what we will do is we will remove the old shareholders. So we will, so the old shareholders' equity will be set to zero. This is like erasing the previous owner's name from the property deed. Afterwards, what we will do is we will add the new equity from the PE firm. So the private equity firm puts in money, their own cash to help pay the deal. So this becomes a new shareholders equity. So sometimes we also add management rollover if management keeps some ownership, uh, preferred equity or option holder rollover. Then we will add the new debt used to buy the company. So LBOs use multiple layers of debt like term loan A, term loan B, notes, mezzanine debt, etc. So all of these appear on the new liabilities on the balance sheet. And this is like taking out the multiple type of mortgages and loans to finance buying the house. And afterwards, we will subtract the cash from the purchase. So the company's own cash might be used to help pay for the deal, and this is subtracted from the balance sheet actually. And later on, we will capitalize the financing fee. So the borrowing money costs money. So bank fees, legal fees, and all these fees. So we will capitalize them along with the debt. And instead of expensing them immediately, accountants actually add them as a part of an asset, deferred financing fee, and amortize them over time. And afterwards, write up or write down asset. This is where your initial question comes in. So example is property PPE will be marked up. Intangible assets like brand value may be increased. Some assets may be written down if overstated. All of these changes the company's asset value on the balance sheet. And then we will reset or eliminate the goodwill. The company's old goodwill is removed. New goodwill is created based on the purchase price, the fair value of net assets. And this is the premium the buyer pays. And adjust. Then we adjust the deferred taxes because the asset write-up or the asset write-up affects the accounting values, but not tax values. So deferred tax assets or liability must be added. And at the end, we make sure that the balance sheet matches. Assets must be equal to liabilities plus equity, but if something is missing, goodwill or deferred tax assets, it's okay. Because at times, balance sheet doesn't matches. If we are only looking at the impact of what would the changes, so it would not match. But when we do a three statement model, it should match. So in an LBO, you actually replace the company's old equity with the private equity firm's equity. I'll add a large amount of new debt, adjust assets value through write-ups or write-downs, and rebuild the balance sheet so it reflects the new ownership and financing structure. So the impact on the model of these adjustments determine the interest expense, amortization of intangibles, and debt pay down capacity in the projected cash flows. Goodwill and intangibles do not create cash flow themselves, but they affect depreciation amortization, which flows into the income statement and ultimately affects cash available for debt payments. And in short, balance sheet in an LBO is adjusted to reflect the purchase price allocation, the new equity contribution, the new debt structure, and any write up, a write down, and the capitalized financing fee, all while ensuring it balances and sets up the projection for the LBO. Okay, if you are having difficulty to understand this thing, I would suggest you to go to the introductory session of this series where we have discussed about income statement, balance sheet, and cash flow and how do they link up. And in previous lectures, I have discussed where I have calculated a goodwill in some question. So in basic LBO questions, I have calculated goodwill. So I would suggest you to go to that question, that lecture, and try to understand it for a better clarity. Okay, so let's move to question number three now, and I will try to cover only three questions in this reading because these are advanced questions, and I'm not. I'm trying to cover everything and not miss any of the topics. So let's move to question number three. Question number three is normally we care about the IRR, internal rate of return for the equity investors in the the private equity firm that buys the company. But how do we calculate the IRR for the debt investors? The IRR for the debt investors and how it's calculated. So first of all, what is an IRR? So IRR is actually an internal rate of return. So your annualized rate of return, considering all cash you put in and all cash you get back over time. So if you put in money today and get money back in the future, positive cash flow. So IRR tells you the average yearly return, and think of it like if you invest $100 today and get 120 next year, this would be your yearly return. So 20% would be a yearly return. And if you're comparing equity IRR versus debt IRR, so equity IRR is the measure. It actually measures the return to the private equity owners, and this depends heavily on how much the company can be sold for. And for a debt IRR, which is actually for the lenders, it actually measures the return of the people who loaned money and banks, hedge funds, or bondholders. So, debt investors don't own the company, they just get interest payments and principal payments. And on the basis of that, if we think about it, it's very difficult to answer this kind of a question. Okay, so let's try to understand. So, how much do you, so how do you calculate internal rate of return for debt investors? So we actually treat debt investments like a loan only, and debt investors invest money that is the amount they lend, and the debt investors receive the money that which is interest plus the principal paid back each year. Then we run the IRR math exactly the same way as an equity IRR. If you were to do, let's break it down step by step. So you understand this thing. So first of all, you need to determine the cash flow to the debt investors. Before that, let's start with the initial loan amount. So this is negative because the money the lender gives out would show a cash outflow. So let's assume that it's $100 million of our cash outflow. Then we add the cash they get each year, which is interest plus principals, interest plus principal payments. So let's assume that every year they are getting $8 million of interest and $10 million of principal, which would make further on 18 million dollars. So in the final year, they had remaining loan balances. This means that if company has not paid off any of the debt before the end of the LBO, so whatever principal is left, which is the final cash flow, so this is similar to the exit value for the equity investors, but applied to the remaining debt. And for example, if $30 million of the loan is unpaid in year five, the company pays it back at the exit. So we are assuming, let's assume that it's a 5 year loan. So the 5 year loan, 5 year, the year five actually includes the interest payment, the principal payment, and the remaining balance of the cash. And IRR is just a simple formula. So you will plug in all the numbers, um, the initial amount of the loan, the principal and the interest payment for all those years, and at the end of the term, if there is any amount left for the loan, you plug in at the end of the year, then you try to annualize it, internal rate of return, and you calculate the annualized rate, which is actually the IRR. So why debt IRR is usually lower than equity IRR? Because debt is actually safe. So here you will find that it would be lower than an equity IRR because debt is more safe. The returns are fixed and predictable, and they do not benefit from the company's growth also. And equity investors actually take more risk. They get money only after all the debt is paid. But if the company grows, they also make huge returns. So equity IRR is usually higher, but debt IRR can be higher I mean, in some of the cases because if the LBO goes poorly, the company sells off for a low price and equity investors lose money. But if you are comparing debt to equity, So equity, if although equity investors do make more return on when equity investors make more IRR as compared to debt IRRs, debt internal rate of return. But one situation could be that the equity investors are losing money. So in that case, debt IRR will be making more money because their debt is actually secured and they get first paid. Debt investors still get paid interest and principal, and that's why. And in that case, debt IRR can be higher than an equity IRR. And think of it like that, like this. So if a debt investor gets paid even in bad time, so and an equity investor get paid only in good times. Debt investor gets paid in bad times also. And to calculate the IRR, treat the loan like an investment. Year zero is the loan amount, so it will be negative. Each year, the interest rate, there will be positive effect on interest rate and the principal received. And in the final year, you add the remaining loan balance, then you run the IRR calculation on the series of cash flow, and you will get the internal rate of return. That's pretty much simple. Once you will do it, you will understand it. So for debt deals, IRR treats the debt like a fixed income minus investment and initial outflow, which is equal to debt issuance. Annual inflows is equal to interest plus principal payments, and the final inflow is remaining principal. Then you calculate the IRR. So that's pretty much it. So it's not a big deal to calculate internal rate of return. So my question is to you guys: if you are attending this lecture, so if I am a lender and I am giving out a loan to a company at a rate of 10%, so should my IRR be equal to 10%? And if you are attending this lecture, I would request you to comment in the comment section so that I will also get to know how serious are you about finance. So should the IRR be equal to the interest payment on the loan? All right. With this being said, let's conclude today's session, and I will see you in next session. All the very best learning.